What if I told you the next several minutes will be the most important several minutes of your business career? Would you dismiss this as ridiculous? Well, what if I told you the biggest payment you will ever receive pertaining to your business will come from the sale of your business? You'd probably agree with me, right? If you're like most business owners, your net worth is tied up into your business. My name is James Riddle. I'm the founder of Atractivo Business Services. We help business owners grow and sell their business for maximum profit. It's not how much you sell your business for that's important. What's important is how much you get to keep after you sell your business. We help business owners put more money into their pocket after they sell their business. We also offer business owners opportunities to grow their business through financing. In the next several videos, we explain what we do, how we do it, how you can benefit from it, and how you can get started. So please grab pen and paper, take notes, and then take appropriate action. Hello. You are here because either myself or someone from my company has reached out to you and provided you an invitation to view this brief instructional video on how to sell your business for maximum profit. If you are not interested in selling your business, I apologize for the confusion. Someone must have misled you on the purpose of this video. You can stop watching the video and continue running your business. And I'm sorry for the confusion. If you are interested in selling your business, the information I'm about to provide you may shock and may even upset you. Please don't shoot the messenger. I'm here to advise you on the most appropriate steps to take in order to sell your business for maximum profit. With that being said, I am James Riddle, founder of Atractivo Business Services. I've worked in mergers and acquisitions and also as a business broker. I am fully qualified to explain the process used by both. My education and previous career was in information technology, and the skill sets and experience gained from my years in IT have provided me with the ability to create new revolutionary methods to buying and selling businesses. This is about helping you understand how to sell your business for maximum profit. Before I continue, I recommend you have pen and paper in front of you. First, it is important for you to understand why you are watching this video. So please write down the reason you wish to sell your business. Do you want to retire? Do you want to buy a different business? Are you frustrated with the business and just want out? Whatever your reason, please write it down now. Again, the purpose of this video is to help you understand how to sell your business for maximum profit. Let me explain what I mean whenever I say the information I'm about to provide you may shock and may even upset you. You see, according to the IBBA, the International Business Brokers Association, 80 to 90% of businesses listed by business brokers are never sold. Brokers mislead their clients as to the value of the business just to get the listing. So buyers end up wasting time and looking at overpriced businesses. Now, don't take my word for it. Here's what they said in Forbes. Richard Gadbury, a Dallas-based mergers and acquisition advisor, put the buyer search exercise into realistic yet sobering terms. According to the IBBA, the governing body of our industry, the percentage of listings that won't sell is more like 90%. Therefore, it is a daunting task and frustrating for a buyer to wade through the numerous listings that are overpriced. have unsupported cash flow, lack information, and brokers who are not well trained. So the best route is to assist a buyer with a direct search because the best listings are not on the internet. And they know little about the fundamentals of the underlying business, which results in a lot of wasted time gathering information that they should have in advance. Brokers are a bad option for sellers too. Typically, brokers just post listings online and do little more to find a buyer. They don't do all the hard work it takes to proactively find the right buyer for your business. Why? Because it's hard work, and most brokers, like most people, are lazy. So put up an ad, and if it sells, it sells, or so they believe. And if it doesn't sell, they don't particularly care. I mean, sure, they'd like to have it and get the commission, but their rates are so high, averaging 10 to 12% of the transaction, that all they need to do is sell one or two a year, and if the others don't sell, then so be it. But what about you? You've been locked into an exclusive agreement for the You've wasted 6 months to a year of your life. You're frustrated, aggravated, disillusioned, and disappointed. You're left with the same problems that made you want to sell in the first place. You're stuck in the same situation you were before you listed with the broker. While the broker sits fat and happy enjoying his extravagant commission proceeds from one or two sales. But if you feel you must hire a business broker in spite of everything I just covered, refrain from signing contracts to brokers who have the following bad habits. What they say doesn't seem to match up with reality. Many business brokers attract clients by promoting their track record. And why not? Doesn't everyone use a resume of some kind or another to get a job or land a client? But what happens when that track record just seems wrong somehow? Is the advisor claiming they sell $1 million business but only have a smaller type of business in their portfolio? Do they say they know your local market but advise clients all over the state or country? Any business broker worth their salt will be able to back up their claims with evidence. They should have a list of some of their recent transactions along with referrals from both buyers and sellers. An unwillingness to provide such evidence should be regarded as a red flag. They spread themselves too thin. There is nothing wrong with putting in a lot of hard work. In fact, this is a quality that you want to see in a business broker. But if the consultant isn't able to devote the time and energy that you deserve, you could struggle to find the right buyer for your business. Also, take note of the broker's portfolio of business. They should have listings with elite businesses that have been extremely vetted and have proven track records of success. They tell you that you don't need your own lawyer or accountant. Experienced brokers get to know a lot about the ins and outs of buying and selling businesses and get to be pretty good at understanding things like tax implications, buy-sell agreements, etc. Even so, they should never encourage you not to do your own due diligence or use your own accounting or legal resources. It is highly recommended to use any and all experts that you deem appropriate during your due diligence process. You may want to have your CPA as part of the selling team as well as your attorney to advise you on legal aspects of the sale. They use high-pressure sales tactics. Most business broker services are at no cost to buyers. The sellers they work with pay the sales commission when a successful match is made and the business is sold. High-pressure sales tactics, therefore, should be a red flag. The sales process is about finding the best fit for you. You may even discover that selling your business is not the right option at this time, and an educated no is better than an uneducated yes when it comes to selling your business. If someone ends up buying a business that is not the right fit, it is not good for the buyer or the seller. In the best case scenario, they might somehow stumble through, but in the worst case scenario, they could toss the business back into the seller's lap and sue for a full refund. The reason I say the business broker model is broken is because it is based on a one-to-one seller-buyer relationship. What I mean by this is the broker will try to close the deal as quickly as possible to ensure he receives his commission check. In so doing, he will reach out to previous contacts who have expressed an interest in buying a similar business. When you have a situation where there is one possible buyer for your business, you actually have zero buyers because the potential buyer holds all of the cards. He can utilize bullying tactics such as threaten to back out of negotiations at any time if he does not get what he wants. He understands that you have few options and may even threaten to inform competitors that your business is for sale. This would cause problems if your competitors broadcast the sale of your business to your customers. The potential buyer can also drag out the process and wear you down to the point that you are at your wit's end and you accept his offer just to get it over with. And lastly, a business broker typically has a local reach when it comes to his buyer pool. So the types of buyers he brings to the table are individual buyers who are usually coming from a normal job. So the first objective is to replace their compensation. Second, more times than not, they will expect some portion of the purchase price to be seller financed. Finally, the individual buyer will be highly focused on how much bank financing they can bring to the deal. The deal that's not bankable is not likely to get done with an individual buyer. If they fail to receive financing for the sale, they won't have the money to buy your business. There is a better way. Sell it using a merger and acquisition firm or M&A advisor. Merger and acquisitions involving privately held companies entail a number of key legal, business, human resources, intellectual property, and financial issues. To successfully navigate a sale of your company through M&A, it is helpful to understand the dynamics and issues that frequently arise. The types of buyers M&A firms and M&A advisors can offer you are strategic buyers who will have a totally different perspective when they evaluate your business. They already own a business, and oftentimes that business will look a lot like yours. Their objective is to buy your business with the expectation there's some portion of your business they can integrate into their business. It might be they want your business to eliminate you as competition, or they may want one of your key employees or a large customer. The strategic buyer will usually want to integrate your business into their business and operate your business more profitably than you can. Here's the best part about a buyer having a strategic interest in your business. They tend to pay more than individual buyers simply because they have a different set of objectives. Another type of buyer an M&A firm or M&A advisors can attract are financial buyers. These buyers will be thinking about the return on investment that can be obtained from your business. They usually will have a disciplined risk-reward perspective, meaning the higher they perceive the risk of your business, the less they will pay for it. No surprise there. While there are no hard and fast rules about this, there are some parameters that will be helpful for you to understand. If your business has revenue of, say, $2 million or less, the financial buyer may be generally looking to pay 2 to 3 times your annual cash flow. This would imply the buyer is looking for a 33 to 50% return on their investment. There are a number of reasons why privately owned companies sell through M&A companies. An M&A advisor in New Jersey or anywhere in the U.S. can help businesses navigate the legal, intellectual property, financial, and human resources issues that come with buying or selling a business. An advisor is in an ideal position to help you navigate these issues as you seek to sell your business. Price maximization. If you are planning to sell your business, you are bound to receive multiple offers. Some businessmen simply take the best offer they can get. Engaging an M&A advisor can improve the prospects for the seller so that he can get the best value for his business. For example, liquidating 100% of your business may result in a lower acquisition price. This is because the owner of the business is not expected to be around to assist in the integration process. Therefore, remaining with a 10 to 20% stake of the company can inspire confidence and may generate a much higher acquisition price. This is also an advantage for both the seller and the buyer, since the seller will also gain if the stock price increases as a result of their contributions during the integration process. Eliminating doubts and facilitating M&A processes. Business owners may have a high net worth, but for some of them, the money is tied up in equity. The seller may want to turn this equity into cash to take care of emergencies, hospital bills, or sort out a financial issue. Under these circumstances, the business owner may be tempted to sell the moment they get the first offer. This can leave doubts and regrets about the business sold. To ensure the seller gets the price, an M&A advisor can assist in finding an acquirer. An acquirer can get the rights of ownership to a company to facilitate the M&A process. Since in these situations the business owner may not be available to assist in the process, large companies have strategic departments that can handle these processes, but they are often weighed down by legal technicalities and bureaucracy. Getting the right buyer for the right price. A business owner may be concerned about what will happen after he sells the company. For example, the owner may be worried about the employees' welfare and whether they will retain their jobs. Additionally, unless the seller is liquidating 100% of the business, he is going to be working with the buyer post-transaction to facilitate the acquisition and integration process. An M&A company can help the seller find the best price and a buyer the owner is comfortable working with. The M&A advisor is in the best position to find the best fit for the business that will address the concerns of the seller. The exit strategy. Sometimes the owner of the business may realize that the deal isn't right for them after they've sold their business. Starting the process all over again from the beginning can be challenging, especially for early stage companies. An M&A company should be able to save time and salvage the process by finding buyers who were excluded in the initial stages. Other strategies may involve finding partners who can provide funding for your business, who can then offer to buy the business once it starts making a profit. The fee structure. The standard M&A advisor fee model includes a work fee, oftentimes a retainer, referred to as retainer, and a success fee. This is a competitive industry, and fee structures are very consistent between firms of similar quality. At the extreme ends of the range, there are firms that will undertake engagements with no work fee, and also firms that structure their fees entirely on an hourly basis with no success fee. If you see these different fee structures and the reason for the differences not obvious to you, I suggest you find an exit coach or experienced mentor who can help you put them in perspective. This information about the quality and service of M&A firms and advisors is strictly for your benefit. The amount of the success fee oftentimes is based on the Lehman formula, accelerators, and the ideal fee alignment. Some M&A firms still base their fees on the Lehman formula. This formula was created by the old Wall Street firm bankrupted by the mortgage crisis. The formula was originally used for financing engagements, but somehow also came to be applied to M&A transactions. If you think about it for a few minutes, I think it's pretty obvious that a simple linear percentage creates much better alignment between the M&A advisor and the shareholders. The ideal alignment is probably closer to the exact opposite of the Lehman formula. Ideally, the M&A firm would be paid a larger percentage of the last million than the first million. This is often called an accelerator. The main reason this is not more popular is the difficulty of accurately predicting the fair value of the company at the time the transaction completes, often a year or more later. For example, think about a situation where the company's value goes up unexpectedly due to a change in their market, a very large contract or some technical innovation after the M&A engagement is signed. Would it be fair for the M&A advisor to have a much larger fee because of something they had nothing to do with? The converse is also true. Perhaps the economy changes or the business suffers a setback after signing the agreement. A change in the fee percentage would be equally unfair in that situation. For this reason, almost all M&A fees are straight linear percentages of the final selling price. M&A advisor work fees, retainers, or engagement fees. The seller commits to a work fee at the beginning of the engagement. Some firms will invoice monthly over the first 4 to 12 months. This initial fee can also be called a retainer, engagement fee, or upfront fee. This covers the M&A advisor's direct costs during the initial stages, as well as their contribution to the preparation of the selling documents and due diligence materials. For larger transactions, the work fees are usually $100,000 or more. For boutique firms working on a $20 to $30 million transaction, the work fees are usually in the $50,000 to $75,000 range. At the lower end of the transaction spectrum, the work fees don't usually go below $50,000 because no matter how small the transaction, there is still a fixed amount of early work that has to be done. There are firms that will charge lower fees, sometimes in the $30,000 to $40,000 range. Lower work fees are often an indication that the firm has people who are not completely busy. For that reason, lower work fees are also more common when the M&A market is not very active. Interestingly, firms that work on transactions valued under $5 million, usually called business brokers, often do not charge a work fee. It's very unusual for an M&A advisor to undertake an exit transaction without a work fee. Part of the reason is that anyone involved with exits has been in a situation where, at the time of the initial engagement, the shareholders and board are enthusiastic about an exit, but by the time an offer gets to the table, the shareholders have reconsidered. This can happen precisely because the M&A advisor has done a good job and has shown the current shareholders that the company is worth more than they thought. This alone can result in shareholders changing their minds and deciding to continue to own the company for a while longer. The retainer fee, sometimes referred to as the work fee, is a fair way for the professionals to protect their initial investment in helping to facilitate a transaction. It is also a test of how serious the sellers are to actually sell the company. The retainer fee is generally non-refundable, but should be credited against the success fee due at closing. The typical retainer fee ranges from $50,000 to $100,000 in middle market transactions. You will also be required to reimburse the M&A advisor for out-of-pocket expenses. The M&A advisor success fees for selling a business are typically based on the Lehman formula, as I said before. The formula shows that for sales up to the first million, 5% will be dispersed as a success fee, and then 4% of the second million, 3% of the third million, 2% of the fourth million, and 1% of everything above $4 million. Please keep in mind that these success fees are for a fully marketed transaction. If the company being sold already knows who the buyer will be or has it narrowed down to a few prospects, then the success fee should be 1/2 to 2/3 of the amounts I just stated. The success fees above are also typical of gold quality services. Selling a $5 million company can be more difficult than selling a $25 million company. This is because the buyers for smaller companies tend to be either the junior selling people in the large company acquisition teams or the CEOs and CFOs of medium-sized companies. Similarly, the legal and accounting professionals tend to be less experienced. Combined, these relatively lower experience levels and reduced availability means that similar transactions often require significantly more time and effort from the advisor. Even the smaller boutique M&A firms will not usually want to undertake an exit transaction in which the selling price will be less than $5 million. Even at a 10% success fee, a $5 million transaction will only deliver a $500,000 success fee. This is approaching the minimum economic size that even the smallest M&A advisory firms or advisors can undertake. This is why transactions below the $5 million threshold are often done by business brokers or individuals who have developed expertise in this area. Because of the amount of work involved in a $5 million transaction, the success fees are usually in the 10 to 12% range. While the amount of work required to perform exit transactions is similar, whether a company is valued at $5 million or $100 million, the fees for large firms are higher due to their overhead and perceived prestige. Sell it using an investment banker. With the assistance of an investment banker or financial advisor, run a tightly controlled auction sale process so that potential buyers are forced to make decisions on a shorter time frame in a competitive environment. The seller should place all of its key contracts, corporate records, financial statements, patents, and other material information in an online data room early in the process. In many situations, an investment banker experienced in M&A can bring significant value to the table by doing the following: assisting the seller and its legal counsel in designing and executing an optimal sale process, advising on market comparable valuations, determining an appropriate valuation range for your business, evaluating strategic alternatives to selling, helping to prepare an executive summary or confidential information memorandum for potential buyers, assisting the seller in properly populating the online data room, helping to prepare and market the business for sale, including creating marketing materials and coordinating management presentations and site visits, designing and leading the sale process, including keeping all parties on track to meet important milestones, working with legal counsel to evaluate bids and negotiate the transaction agreement, including financing structure and terms, identifying and contacting potential buyers, helping prepare management presentation materials for meetings with potential buyers, and prepping the management team beforehand, coordinating meetings with potential buyers, assisting in the negotiations on price and other key deal terms, preparing and coordinating the signing of confidentiality agreements, coordinating the seller's responses to buyer due diligence requests, reviewing the transaction and rendering a formal opinion on the fairness of the transaction, helping the management team in presentations to the company's board of directors. So how much should you expect to pay an investment banker to sell your business? As you might expect, investment bankers do not work for free. Investment bankers typically charge a success fee or transaction fee along with retainer fee. The success fee is usually a percentage of the deal value. The deal value includes the amount of cash and the fair market value of securities or other assets that you receive in the sale. Deal value also customarily includes the amount of an installment note payments, releases from escrow, or earnout payments made by the buyer after closing. But you should not pay a success fee on post-closing payments unless and until the payments are actually made by the buyer. The percentage of deal value may be fixed, such as a 2% or 3%, but can also be structured as an adjustable formula-based success fee where the percentage change certain amounts or breakpoints. For example, the success fee might be structured as 1.5% for the deal value up to 20 million, 2% for the portion of deal value in excess of 20 million up to 30 million, and 3% for any portion of the deal value in excess of 30 million. The success fee is typically subject to a minimum fee that the investment banker must be paid at the closing. In my experience, the minimum success fee usually required by experienced middle market investment bankers is between $500,000 and $700,000. Investment bankers try to lock in the success fee and protect themselves against your terminating their agreement before the closing occurs. The engagement letter will likely include a fee tail period that remains in effect for 9 to 12 months after the engagement is terminated. If you terminate the engagement before closing and then later complete a transaction on your own or with another investment banker during the fee tail period, you will still owe the success fee to the first investment banker. You may be able to negotiate certain exceptions to the fee tail. For example, the investment banker may agree that the fee tail applies only to buyers that the investment banker contacted about the deal during the engagement. Investment bankers customarily require payment of an upfront retainer fee when the engagement begins. The retainer fee is generally non-refundable, but should be credited against the success fee due at closing. In my experience, the typical retainer fee ranges from $50,000 to $100,000 in middle market transactions. You will also be required to reimburse the investment banker for out-of-pocket expenses. While the success fee, the retainer fee, the fee tail period, and the expense reimbursement are common elements in almost every engagement letter, you should remember that the dollar amounts, percentage amounts, breakpoints, and other terms in the engagement letter can and should be negotiated. If properly structured, the engagement letter terms will motivate the investment banker to help you achieve your goals in the sale of your business. Sell it with your attorney running a silent auction. You can buy everything from old farm equipment to fine art at auctions. Even cruise ships have capitalized on auctions by selling artwork to a captive audience in the mood to spend money. When you hear the word auction, you probably think of an online auction website like eBay or a traditional auction house where people bid on rare collectible items. Both auctions are similar in nature because they involve a series of bidders who are competing to purchase a particular item. When a bidder places a bid, it must be higher than the previous bid or starting price. The objective is to outbid all the other bidders by getting them to stop bidding. They will eventually do this once they feel the current bid price is too high or too out of their budget. As a business owner, you can offer your entire business for sale by auction. Many business owners do not even consider doing this because they assume that auctions are only for selling tangible items. They do not even realize that auctions can gain them a very high selling price for their business. It may be higher than their minimum asking price. The best part of this is that the terms of the auction sell are usually more beneficial to the seller. However, most business owners do not realize that a silent auction can be the best way to maximize the value of your company when you sell. Experienced investment bankers know how to tap into the potential of an auction style sale to boost a company's price and secure better terms. They know how to get prospective buyers turned on, and excited about the opportunity to acquire the business. Then the acquirer is motivated by the opportunity for gain and approaches the auction with a "what's in it for me" attitude. When the auction begins, the buyer realizes right away that there are other buyers at the table. Typically, he doesn't like to see others bidding on the company. However, it confirms his belief that the company is a real opportunity. Now the dynamics of the sale shift. The buyer's mindset goes from opportunity to gain to fear of loss. This drives buyers to raise their bids. The buyers are convinced that the opportunity for gain is real, yet fear of loss drives them to increase their bids to try to keep the company out of competitors' hands. Since the seller is the one conducting the auction, they get to set the conditions and terms of the sale. The bidders who participate in the auction must agree to the terms beforehand. Investors, buyers tend to be more accepting of auction terms which favor the seller because they think they will get a bargain purchase price for the business. In most cases, there is no bargain unless the business is already in bad shape. 5 factors are at work during an auction. I like to call them the auction effect. This is how you get the highest selling price possible. Fear of loss. Buyers do not like to lose at an auction. The reason they bid such high prices is that they want to win. In an auction like this one, they only get a few chances to bid. Buyers know that if they lose, then it could mean the end of a rare opportunity to obtain ownership of a valuable company. Potential buyers have a vested interest in the company they want to purchase. They have done their homework. They have determined that this is the best company of its type for sale at this time. Otherwise, they would simply wait and buy the next one. During an auction, buyers may fear that if they lose the auction, they may not get another chance to purchase a company like this one. This fear drives buyers to increase their offers or negotiate better terms. Time pressure. When you don't use an auction to sell your company, there is no time limit set for the sale. This means there is no pressure to make a deal quickly. However, if you do use an auction, there is a time limit for when bids must be placed. Plus, the bidders feel pressure to place higher bids because they are competing against each other in a fast effort to become the winning bidder. They may bid very high prices just to get your attention and strike a deal. There are no time constraints on a company being sold without an auction. No deadlines, no pressure. If you only have one potential buyer, they don't feel any pressure to increase their offer or to negotiate. They can just wait around until you accept their offer. An auction is different. It can have a definite ending. Bidders know they are competing for your company, and if they want to win, they have to present timely offers. They never know when the company owner may agree to accept another offer, and they don't want to miss the opportunity. Bids go up, values go up. Competition. You don't want an auction with only one bidder. This is an indicator that your business has no value, and it will result in you getting the lowest possible price. Multiple buyers who are bidding to purchase the same business will drive the sales price higher. That is why you should invite as many qualified investors to bid on your company as you can. In today's business world, nobody likes to lose. Everyone wants to win. A lone buyer looking to buy a company does not feel any competitive pressure. They are the only game in town. They can offer whatever they feel the company is worth, and the seller has nothing with which to compare the offer. However, when you have multiple potential buyers, all of whom want the same company, they feel the competition. The seller has other offers to consider. The price goes up. Auctions provide built-in competition for your company. Perceived value. The true value of a company is not always determined by the assets of the company or by its performance. The true value of a company is what a buyer is willing to pay based upon their perceived value of the company. This has been proven over and over as billions have been spent on internet companies that have yet to make a profit. The buyer's perceived value defied normal business rules. A single buyer values a company based upon the value they see. During an auction, multiple buyers are looking at the company, and each has a different perceived value. A strategic corporate buyer may see the value of the company as a perfect strategic fit. A financial private equity buyer may see the same company as less attractive because its potential ROI is not ideal, but still very attractive. When you multiply the number of buyers, the perceived value is enhanced. Each suitor sees the company in a different light. You must compete with others to win. The perceived value increases. Again, the value of your business is determined by your potential bidders. You can present them with information about your company's assets and annual revenue, but this still won't determine the value in their eyes. The perceived value of your company could be unique per bidder. Perhaps one bidder has an idea on how they can enhance your company and make it even better. So they might be willing to bid a higher price just to have this opportunity. The biggest factor that influences a company's perceived value is the number of interested buyers there are for it. Like previously mentioned, bidders that see a lot of bidding competition will assume the value of the company is high. Otherwise, why would so many bidders want it? External validation. Bidders want some validation that your company is valuable enough to purchase. So they will look for this validation from other interested buyers. Auctions create the perfect setting for bidders to get this kind of external validation from each other. It only motivates them further to stay involved in the sales process and bid a higher price. Often buyers need to know that others see the potential value of a company before they will make a serious offer. An auction provides ongoing external validation that the company being sold is attractive and that the offers are realistic based upon the market. So what does the silent business auction process look like? Identify potential buyers, privately or publicly publicize your intent to sell your company to attract identified and unexpected potential buyers. Once you know who is interested and how many people are interested in your company, your next step will be clear. Give your sales presentation and pitch book to those buyers. After executing confidentiality agreements, show off your pitch book. Impress buyers with your company's historical growth and give your sales pitch to drive up bids. Accept indications of interest from the buyers. Buyers' indication of interest will provide you and your team a range of your business sale price. Some buyers may offer $2 million to $4 million, while others may bid between $10 million and $15 million. Their offers will indicate the valuation you can expect from your business. Answer buyer questions. Next, Give the buyers the chance to walk around your business and kick the tires. Begin working with those who have offered the highest bids and set up Q&A sessions with their teams. If you can answer their questions clearly and concisely, they may present a higher final offer than their indications of interest said they would. Receive and accept a final offer. After you've satisfactorily answered the buyer questions, let your final few potential buyers make their final offers. If they're competing against one or two others, they may raise their bids higher than you expected. Accept the bid. The highest bid or the bid from the buyer you like the most. Enter into final negotiations. Once you've accepted one buyer's offer, let your exit team and their purchase team negotiate terms that will be advantageous to both parties. Close the deal. Finally, get to the closing table, receive your check, and start the next phase of your life. So that's the most basic way to describe the way a business auction works. It's most likely not the auctions you've seen before, and it can be held publicly or privately. Not only does a silent auction help to enhance company value, it also provides the seller with more negotiating power. The seller can work with potential buyers to craft the perfect offer that more closely meets both their financial and personal goals. The estimated amount of attorney fees for selling with a silent auction is $15,000. The actual amount will depend on your attorney's hourly rate, experience level with silent auctions, and the amount of time of his involvement. Sell it yourself with seller resources. There are reasons you would sell your business yourself rather than through a M&A firm, M&A advisors, or an investment banker. Such as your business is a small business generating less than $5 million in annual revenue. You don't have the required retainer fees set aside for an M&A firm, M&A advisor, investment banker, or even your attorney. You wish to keep the majority of the proceeds from the sale and not pay a success fee to anyone. You have very little buyer interest. You want to pitch several buyers, not multiple people in multiple regions. You've already identified a strategic buyer, a family member, an employee, a competitor, etc. You wish to sell the business within 2 years max. So what does the forced sale by owner using seller resource process look like? Identify potential buyers. Privately or publicly publicize your intent to sell your company to attract identified and unexpected potential buyers. Once you know who is interested and how many people are interested in your company, your next steps will be clear. Give your sales presentation and pitch book to those buyers. After executing confidentiality agreements, show off your pitch book. Impress buyers with your company's historical growth and give your sales pitch to drive up bids. Accept indications of interest from the buyers. Buyers' indication of interest will provide you and your team a range of your business sell price. Some buyers may offer $2 million to $4 million, while others bid between $10 million and $15 million. Their offers will indicate the valuation you can expect from your business. Answer buyer questions. Next, give the buyers the chance to walk around your business and kick the tires. Begin working with those who have made the best offers and set up Q&A sessions with their teams. If you can answer their questions clearly and concisely, they may present a higher final offer than their indications of interest said they would. Receive and accept a final offer. After you've successfully answered buyer questions, let your final few potential buyers make their final offers. If they're competing against one another, they may raise their bids higher than you expected. Accept the offer. The highest offer or the offer from the buyer you like the most. Enter into final negotiations. Once you've accepted one buyer's offer, negotiate terms that will be advantageous to both parties. Close the deal. Finally, get to the closing table, receive your check, and start the next phase of your life. So that's the most basic way to describe the way you can sell your business with seller resources. The process looks identical to the silent auction process with one exception. You are the person receiving, evaluating, and negotiating the offers, and not an investment banker, your attorney, or a specialized silent auction attorney. You are also the one creating your company's pitch book and driving the process from start to finish. Sell the business yourself without seller resources. With this option, you would find a buyer, negotiate your sale price, close the sale, and collect the check. If you have sold businesses before, this may be the option best suited for you. No doubt you have copies of forms and agreements, as well as knowledge on how to market your business to potential buyers. You would still need an attorney to review the final agreements and possibly a commercial real estate agent if the sale includes real estate property. Now, please write down the options for selling your business. Option 1, sell it using a business broker. Option 2, sell it using a merger and acquisition firm or M&A advisor. Option 3, sell it using an investment banker. Option 4, sell it yourself with a silent auction. Option 5, sell it yourself with seller resources. And option 6, sell it yourself without seller resources. Now let's review each option. Option 1, sell it using a business broker. Ask yourself these questions. Knowing that 90% of businesses listed with business brokers will not sell, why do you think your business will be in the 10% of businesses that do sell? How much time do you have to weed out brokers who have bad habits? How comfortable do you feel negotiating with only one potential buyer? If you feel extremely confident that you can sell your business for maximum profit after answering the previous 3 questions, then circle option 1. Otherwise, strike through option 1. Option 2, sell it using a merger and acquisition firm or M&A advisor. Ask yourself these questions. Knowing that the M&A process typically takes between 2 and 5 years, do you have the time and patience to see it through? Knowing that the M&A firms and advisors typically charge an upfront fee anywhere from $20,000 to 50,000, do you have that amount available in order to begin the process? And knowing that the M&A firms and advisors typically advise clients who are generating over $5 million annually, do you meet the income qualifications? If you feel extremely confident that you can sell your business for maximum profit after answering the previous 3 questions with this option, then circle option 2. Otherwise, strike through option 2. Option 3, sell it using an investment banker. Ask yourself these questions. Knowing that if you terminate the engagement before closing and then later complete a transaction on your own or with another investment banker during the fee tail period, you will still owe the success fee to the first investment banker. Are you okay with paying the success fee? Knowing that an investment banker typically charges a retainer fee anywhere between 50,000 and 100,000, do you have that amount available in order to begin the process? Knowing that an investment banker typically advises clients who are generating over $5 million in revenue annually, do you meet the income qualification? If you feel extremely confident that you can sell your business for maximum profit with this option, after reviewing the previous 3 questions, then circle option 3. Otherwise, strike through option 3. Option 4, sell it yourself with a silent auction. Ask yourself these questions. If you had the training, resources, and guidance, how comfortable would you feel selling your business using a silent auction? Knowing that you would need to pay your attorney or a specialized attorney an hourly fee to help you sell your business with a silent auction, how comfortable would you feel selling with this option? Knowing that you would not need to pay anyone a success fee, how do you feel about selling your business with a silent auction? If you feel extremely confident you can sell your business for maximum profit using this option after answering the previous 3 questions, then circle option 4. Otherwise, strike through option 4. Option 5, sell it yourself with seller resources. Ask yourself these questions. If you had the training, resources, and guidance, how comfortable would you feel selling your business? Knowing that you would save attorney fees by using the forms and templates needed to sell your business, how comfortable would you feel about this option to sell your business? And knowing that you would not need to pay anyone a success fee, how would you feel about selling your business with this option? If you feel extremely confident that you can sell your business for maximum profit with this option after answering the previous 3 questions, then circle option 5. Otherwise, strike through option 5. Option 6, sell it yourself without seller resources. Ask yourself these questions. How many businesses have you sold? How comfortable do you feel with possibly leaving 40 to 60% of your equity on the table when you sell? How comfortable do you feel finding the best buyer for your business who will be unlikely to toss the business back in your lap and sue you for a full refund? If you feel extremely confident you can sell your business for maximum profit with this option after answering the previous 3 questions, then circle option 6. Otherwise, strike through it. I hope this video has been helpful and has provided you with an understanding of the best way to sell your business for maximum profit. Selling a business can be an extremely financially rewarding experience. It can also be an extremely frustrating experience if you aren't equipped with the proper tools and resources. As of July 18, 2019, Warren Buffett's net worth is $82 billion. He accumulated his massive wealth by following 2 basic rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Jim Rohn, the author of The Art of Exceptional Living, once said, "Formal education will make you a living. Self-education will make you a fortune." Over the course of time, you've had the opportunity to educate yourself in the matters of money, investing, business transactions, customer service, employee relations, contracts, marketing and advertising, and other business-related topics. I would like to ask you, how much have you learned about protecting the equity in your greatest asset, your business? I have created a video collection which will help you understand the importance of preserving the equity you have built in your business. The short videos are designed to educate you on the opportunities currently available to you as a business owner. Opportunities to put large sums of cash into your pockets immediately, as well as over the next 6 to 12 months. Because minds are like parachutes, they work best when they are open. I'd like for you to keep an open mind when viewing the videos. Chances are you have never seen opportunities like these before, and you may never see them again. The first couple of videos provide you with strategies to put money into your bank account. The remaining videos are designed to help you understand the current financial situation of the world and how it affects your business and your life. At this time, I would like for you to grab pen and paper and write down your answers to the following questions. Question number 1. How much money do you believe your business is worth today? Question number 2. Is the amount of money you just wrote down on your piece of paper based on a formal business valuation? What someone told you it was worth? A result of a calculation you just performed? Or a wild guess based on wishful thinking, otherwise known as a super wild ass guess? Question number 3. How much money are your non-business related assets worth today? These assets include cash you have in personal and checking savings accounts, money market accounts, gold and silver, equity in your home, stocks and bonds, etc. Question number 4. Do you believe the amount of money you just wrote down for your non-business assets is enough money to retire on? In other words, do you believe the amount of money you just wrote down will pay your living expenses, medical expenses, taxes, etc. for you and your significant other for the rest of your life? Question number 5. What have you done recently to protect the equity in your business? Now I'd like for you to click on the button below, because as Mark Twain once said, the secret of getting ahead is getting started.